Looking for it. All right.
All right,
Right.
perfect,
Fantastic.
fantastic. So, yeah, time just ticked over 12:30. We will start. Welcome everyone. This webinar is brought to you by Saturn Advice. My name is Joyce, a financial advisor, and also your host today. Now, thank you for taking the time and being here. And happy Friday. And I hope you do enjoy the next hour. Now, today's topic is up on the screen: retirement planning. Um, we all make sacrifices today to amass wealth with the expectation that when we retire, it can be converted to purchasing power. Now we have it tough because environment is such that interest rate is still fairly low and inflation is running really, really high. And we all wonder at some point, will we have enough money to retire? Well, lucky for us, we've got a great speaker today who will share with us some strategies on how to get on track and stay on track with retirement. Let me introduce our speaker. So we've got Shahrukh Abdali. Shahrukh is a financial advisor at Saturn Advice. He is also a CFA charter holder, which is one of the highest distinction when it comes to money management profession. Welcome, Shahrukh.
Hello, Joyce. Welcome, everyone.
Great. Now, before I hand it over to Shahrukh, you're going to bear with me for 30 more seconds. Just want to go through some basic housekeeping stuff. So we will be recording this session. If you want to play back and listen to the key bits, a link will be sent to you in the coming days. And also, we do have a live Q&A session today. Throughout the webinar, if you have any questions, use the question button, which is located at the left-hand side of your screen, your auditorium. And don't be shy, pop your question in there. We will address them in the last 15 to 20 minutes or so. Without further ado, I'll hand it over to you, Shahrukh.
Thank you. So I'll kick on. Before I go any further, just want to say that nothing that I say today should be taken as personalized financial advice. I do not know the personal circumstances for my audience today. So if you want specific advice which is tailored to your circumstances and goals and objectives, do get in touch with a good financial advisor. No warranties for today. I've taken all the steps and due diligence to ensure that the information that I put in front of you is accurate. But again, I am relying on third-party sources, so I cannot guarantee the accuracy of that information. If you were to take away any information and act upon it, or anything that I say, you take that as advice, well, the decision is actually yours. You cannot hold me or Saturn or any employee or director of Saturn liable for the outcome of any such action that you take. So please do not act upon it without seeking advice from a good financial advisor. Today is just for information. Before I go into the core of it, I'll just give a quick rundown on who we are. So the Saturn group of companies, the parent company is Saturn Portfolio. We've got 3 companies within that. Saturn Advice is where I sit, the financial advice business. We specialize in investment planning and discretionary investment management. I'll delve more on that bit if we have time at the end, but I'll just move on for now. Saturn Invest is the superannuation scheme, which is qualified to accept UK pension transfers. And we also got a digital advice for Kiwi Saver. It's actually a pretty good business. You can go onto their website and they've got a health check, which is free of cost. And you can use that to find out if you are in the most suitable Kiwi Saver fund. So do check it out, National Capital. Now, more on Saturn Advice. The business originally was founded more than 30 years ago. We strive to help people take the right financial decisions and, as a result, create richer lives for themselves. The business model that is pretty unique for us is that we provide impartial advice, and we are not aligned to any of the fund managers that we recommend for our clients. The key part that I feel is, very unique to Saturn. I mean, there are quite a few advisory businesses who can claim that they are independent because they are not aligned with a fund manager or take any commissions or remuneration from the fund managers. But what sets us apart is all employees at Saturn are paid a fixed salary and a fixed salary only. There isn't any bonus or any commission that is paid to anyone at Saturn. So Saturn Advice, and that is something which me, for example, as an advisor, just frees me from any conflict whatsoever. I do not have a sales target to achieve at the end of the year. So all I'm looking to do is provide the best possible advice to my clients and get paid for it. We've got offices in Christchurch and Auckland, and a vastly experienced team looking after clients, which include individuals, families, trust, states, and companies. That's about it for Saturn. Now, what we'll be talking about today for most of the session is practically in three parts. Firstly, well, where you're at in terms of your retirement, what you need to be aware of, why you should be planning, why you don't, the different phases of retirement planning and the key factors you should consider, how to go about retirement planning, the blueprint for it, what are the tricks of trade per se, and I'll also touch upon a couple of favorites for Kiwis in terms of planning for their retirement, their favorite assets. And lastly, I'll talk about who can help you plan for your retirement. And spoiler alert, a good financial advisor can. Moving on to the first phase. So how you currently positioned? Well, as Joyce pointed out, it is getting pretty tough in the current, low interest rate environment. I mean, interest rates are beginning to creep up a little bit, but they are really, really low and below inflation. And as this cartoon suggests, retirement is becoming a bit of a luxury for quite a few people who might end up delaying retirement unnecessarily, particularly if they don't plan. So why don't people plan? I've compiled through some of the most common questions that I have come across. The first one that is the most common one is, it's particularly with the younger ones, it's a long way off from me. I just want to live my life. Just want to have some fun. I will expand more on it later on, but the key part is if you start early, it is much easier than if you wait until the later years, and I'll prove it later on today. Some of the people I talk to just find it too hard, and it's just too complex. Well, that's why you've got financial advisors like me who can help you out. But again, the key bit to take away is if you don't plan for it, you're planning to fail. And then this is one of my favorites. I just don't seem to have any surplus cash to put away towards retirement. And here I'll share a classic example of mine. A client of mine who got a small inheritance, put it through to a portfolio, and he was making about above average income at the time. And I asked him, well, you're young, let's start with a contribution plan towards your portfolio, and you'll have wealth accumulation over time. And he told me exactly that. Well, I don't have any surplus cash. A few years down the road, he was earning more than twice what he was earning a few years earlier. And I asked him the same thing, and he still did not have any surplus cash. So the key part that I derived from that is humans are very good at adjusting to our circumstances. So if our income goes up, we adjust our spending habits accordingly, and we are spending everything again. And that actually works the other way around as well. So if we sort of reduce our available income by setting aside an amount that would go into retirement investing, then we would automatically adjust to whatever is available for us to spend without actually feeling suffocated. And I've seen that happen. So that is something, again, a financial advisor can help you get through. Some of the respondents felt that New Zealand Super will be okay. Well, for a decent lifestyle, it may not be. And for the younger ones in the audience, it may not even be there. I'm not going to bank on receiving New Zealand Super payments. KiwiSaver is really good. And if you are contributing to KiwiSaver, yep, you're doing the right thing. But again, will KiwiSaver be enough? Well, it really depends on the type of lifestyle that you want in your retirement. And again, a financial advisor can help you determine that. So for some of you, it may be enough, but for many, it may not be enough, particularly if you are closer to retirement, because KiwiSaver hasn't been around for too long. And this is the favorite. I do not intend to retire. Now, this is great because that tells me that you love doing what you do, which is great, fantastic. But I love doing what I do, and I don't intend to retire until, I can't work. But it would be nice to have that choice if circumstances meant that I have to retire or, I can't continue. So it is always good to plan for that and have that choice, even if you do not intend on retiring at 65. Now, what are the different phases of your retirement? So, if for the younger ones in the audience, you are a few years to retirement, well, the key question is, how much do I need for retirement? How much do I need to accumulate in order to derive an income which is going to sustain my desired retirement lifestyle? Again, a financial advisor can help you determine that part. And for those who are closer to retirement or are retired, the key question becomes, well, how much can I spend in my retirement and not worry about running out of money before, running out of time? So that is, again, something that a financial advisor can help you determine. Now, key factors to consider when thinking of retirement, particularly for the younger ones, but it does apply for anyone who's a few years from retirement. The largest capital is your potential to earn. So how can you maximize that is what you would be considering, particularly if you're on the younger side. But more general questions that would apply to pretty much everyone is, what are your life goals? So what makes you happy? What would you like to do on a daily basis if you did not have to go to work to make a living? And that would paint the picture of the type of retirement lifestyle that you want. Again, it depends on whether your retirement lifestyle means that you are going to be living on a penthouse or looking to harbor, or you just want a small cottage in a small town, and you want to go on overseas lavish cruises, or you just want to go to the beach. What type of car you want to drive, and what you want fine dining, or a family home cooked family dinners are your thing. So those things will determine the type of income you want in your retirement, or you need in your retirement. Also, factors that are important is if you want to help your children buy their first home. This is becoming more of a concern for quite a few of my clients, given the property prices in New Zealand, one of the most expensive property markets in the world. Some of the younger clients have also set up funds to help their children with their education. We have the study link, student loans that Kiwis can access, but that limits them to studying in New Zealand. If they wanted to go to overseas university, then they gotta pay for it. But it's good if you start accumulating for it over the years. Your children are young, and by the time they reach university age, they have the option to either study locally or use the funds to go overseas. And then you also have to think about whether you want to switch off and retire at one point in time, or you first sort of phase yourself out, you reduce your hours, as quite a few people like to do, and then think about when you want to retire. And all of those can then help you determine when can you retire. Now, how to go about it? So let's just move on to the first part that I touched upon. The earlier you start, the easier it is. So this is proven by numbers here. On the first part, you can see a younger person who's got 30 years to retirement, and then someone who's a bit further down on the career stage and has got about 10 years to retirement. What I've done for comparison purposes is assume the same annual return, so about 6%. Average return. It's don't take that as to be the expected return that we can achieve for you, but just for hypothetical comparison, I'll put that. The monthly deposit is approximately 1/3 for the younger one, and 3 times for the older person. The ending value is twice for the younger person, even though they have contributed slightly less than the older person. So the contribution for the two of them is virtually the same, a little bit less for the younger one, but the younger person ends up more than twice the amount of retirement pool, simply because they were contributing over a longer period of time. So that's the power of compounding. The way it works is you put your money in, that grows as a result of the return that you achieve, and then the next year the principal amount plus the return that you achieve is the pool, and then you earn a return on the return of the prior years, and that just keeps accumulating. So if you have a lot of years to retirement, well, it's a lot easier compared to someone who just waits until they just try to chuck away large sums of money and try to make up for the lost years. So start early. That's the bottom line here. Now, if you are closer to retirement or you're retired, well, what happens to you? Well, your key question is, well, how much can you spend without worrying about running out of money? So, at a high level, I've painted three pictures here. If you go really hard on living a retirement lifestyle, you might end up spending all your money too early, and then have to just go buy whatever super payments if they are there, and thereabouts. But on the flip side, I also have come across people with quite a bit of retirement pool, and they just don't want to spend, simply because they're too scared of running out of money. Well, if you do that, you might get to your 80s or late 80s and realize that you've got just a huge chunk of money, and you have kept yourself from using that to live the life that you wanted in your retirement, simply because you were fearful, and now you just don't have the health or the energy to actually use the money. So you just need to come to a bit of a balance where you are living your life in your retirement, but at the same time, you're not running too hard on the retirement pool and not running too slow, so that you're ending up with too much money towards the end part of your retirement. So again, a really good financial advisor can help you answer those questions and make sure that you stay on track. Now, on to the most favorite assets or most commonly used assets for investment by Kiwi. So the first one is obviously term deposits, and has been a client favorite, particularly for the retirees, who have accumulated wealth, and they just chuck it into the term deposits and they live off the income. Well, the good part is the term deposits are easy to understand, easy to transact. You don't generally need advice in terms of investing in term deposits. You know what you're going to get at the point of investment. You know the return you're going to get, and are generally considered safe. I say generally because there was a misconception among some of the people I talked to, thinking that term deposits are guaranteed or they're bulletproof. Well, they're not. They were guaranteed by the New Zealand government until the global financial crisis happened. After that, the open bank resolution was put in place, which meant that the banks can now freeze the term deposits if they get into financial strife, and they can use the term deposits to pull themselves out of the financial problems and then release whatever is left over. It's going to be like a haircut on the deposits that you put in the bank. But this is not to suggest that the New Zealand banks are vulnerable of financial strife. They're very well capitalized, but they're not bulletproof, at least on theory. But more importantly, the term deposit rates, you can see the graph at the bottom left, that is showing the trajectory for term deposits over the last 60 years, almost. And you can see that right now the term deposit rates sit at the lowest point as they have been over the past 60 odd years, 6 decades. So while term deposits used to provide a decent return in the past decades, right now that's not the case. And the bottom right chart shows the 6-month term deposit rate over the last few months, over the last year. And you can see that, it has continued to come down, and it still is at pretty much at the bottom. It's just beginning to creep up over the past month or so, but it's not going up in a hurry. And the key part about that is term deposit is a cost to the bank. So, while banks are very keen to raise the mortgage rates well ahead of any increase in rates by the RBNZ, they are not in such a hurry to raise term deposit rates because it's a cost to them. So that's how the banks work. So mortgage rates have already doubled. Well, not really doubled, but getting up there. So over the past 6 months or so. But term deposit rates, well, they've barely started to move up. The other favorite is residential property, more so than the term deposit. So why is it so popular? Well, first thing, it's in Kiwi psyche to own a property, and it's considered to be a mark of success. Well, I own a few properties. I'm a landlord. There is a perception that they're safe. I say a perception because property actually, the value of the property is it behaves the same way as any growth-oriented asset. The only bit is it's not priced on a daily basis. It is only priced when a property is sold. If there were buyers coming in every day and were pricing your property or your investment property on a daily basis, you would see the fluctuation in the price of your property on a daily basis, just like you would on, for example, if you own shares. But the perception comes, the safety perception comes for property from being able to see the property. It's a brick and mortar asset. It's tangible. You can drive by it. You can visit it. The important part, the advantage of investing in property, comes from using leverage. So you would invest in property. It's very unlikely that you would be investing in property by 100% cash. You would put in some of your money, but then you would rely on the bank to lend you some money to buy that property. So, the loan to value ratios are in place. So, for those of you who are familiar with property investing, would know what I'm talking about. You have to put in some of your money and then rely on the bank to give you others. Now, to highlight how that gives an advantage to property investors or investing in property is that, say, if you put in 50% of your money and then 50% comes from the bank, and say the property prices went up by 10% in a year. I'll come to why that is a very high movement for property prices. I'll prove it, that that's a really high movement property prices for a 12-month period, but that's what has been happening over the recent months. If, say, it goes up by 10% and you've put in 50% and 50% has come from the bank, your effective return actually becomes double, because only half of the money that you've put in buying the property is yours. The rest of that is come from the bank. So your effective capital growth is not 10%, it's actually 20%. It has been tax effective, historically at least. Now with the new tax laws, that is becoming to that's going to be phased out. So starting next year, 25% of the tax losses on investment property can't be claimed against other taxable income. So that's being phased out over the next 3 years. There's a history of strong capital gains, which have been aided by some factors, including really high net migration. Interest rates have dropped to historical lows, and was easily accessible, and there was a shortage of houses in New Zealand, particularly in Auckland. But quite a few of these factors were already fading and are beginning to turn around. So migration was already slowing down even before COVID happened. Right now, the borders are closed, but even if the borders were open, I don't think there would be a flood of people coming back to New Zealand. And I can go into a lot more detail into why I think that's the case. But the key thing is migration historically for New Zealand has been flat to moving sideways. So there have been years where migration would be positive, and there would be years where migration would be negative. But between 2013 and 2017, net migration was historically high, and that created that bit of shortage in the housing market, and that was a major factor for pushing up the prices along with low interest rates. Now there's been a ban on foreign buyers. There have been those laws in place with like the extension of the bright line test, which effectively puts a capital gains tax on existing properties that are bought for investment reasons. I've already talked about interest deductibility, which is being phased out, and there have been a whole array of favorable policies for tenants that have been introduced by the Labour government, which is just creating a lot more headache for landlords. So property investing is still great if you are wanting to achieve capital growth, but it's not the same as a class as it was, say, 5 years ago or 3-4 years ago. It's just not as easy or as simple as it was back then. So you need to be really careful about putting all your eggs in one basket, per se, properly. I'll also put in here a bit of a comparison of, okay, if you were to look at property in terms of a source of income, what would it mean and why it does not make sense to look at investing in property as a source of income. I've got quite a few people who, property investors are just so passionate about property that all they want to do is just invest in property. So even if they hold a portfolio, they would still be investing in property and they would be looking at property to derive an income. So I've got here some numbers, two scenarios, one where you've got debt on your rental property and the other one is mortgage free. I'll put in the median rent and the income and then the usual expenses that typically might apply for an investment property. The key point that I want to raise here, most people I talk to, when I ask them, well, what do you think is your return on a rental property? What they tell me is the absolute dollar figure. So when you look at the absolute dollar figure, for example, for a mortgage-free property, $25,000 is $2,000 a month on a rental property. Well, that's not really bad, but hang on, how much capital have you got stuck in that rental property? When you take that into account, that's a median Auckland house price from about 3 months ago. Now I think it's 1.150, or at least it was end of September. If you take that into account for that income that you're getting in terms of your rental income, the percentage return, the yield or dividend income, whatever you want to call that, it's equivalent to all of those terms, is actually 2.25%. Now, 2.25%, is that a return that you'd be happy with? Well, that then starts the discussion. Okay, well, that's a bit low for all the headache that comes with having an investment property and managing it yourself, or even if you've got a property manager, then dealing with vacancies and all sorts of tenant related issues. So it's not really an asset which I would be really keen on in terms of deriving an income. So what are the various options? So the alternatives and the importance of diversification, well, I just touched upon not having all your eggs in one basket. So what are the different baskets? You've got term deposit, you've got property, you've got direct shares and bonds. You can have a portfolio of direct shares, and similarly for bonds. Managed fund is my chosen one, but I'll come to that. And private equity is you just invest in private businesses. You could have your own business, and that is your asset, and that's private equity. But managed fund is a medium of accessing all of those without actually being too concentrated on either. So how managed funds work, you pool your money with a portfolio manager, and the portfolio manager would be investing across different asset classes, across different geographic regions, and would be spreading you, in different industries as well as in different regions. So that way, your money isn't really concentrated on one asset class and isn't concentrated on one geographic region either. And that's the most, that's the optimal way of investing, in order to mitigate risk. I mean, everything comes with risk, but that's, the best approach to go about it. And I've also sort of tried to show it visually that you could be spreading yourself across different baskets, but if it's just everything is on one table, well, that table is representing one country or one region. That table could still break. So if you, for example, are living in New Zealand, you are investing in term deposits and you own rental property, or you also have direct shares typically in NZX, well, everything is associated with New Zealand. So if New Zealand were to have an event, an economic event, well, everything is going to get hurt because you are just concentrated in just one country. And mind you, New Zealand is a really, really small part of the global landscape. A good way to show the importance of diversification is like if you owned umbrellas and you own sunscreen. Well, irrespective of which season you would be facing, your overall income would be pretty steady. It's not going to be in a straight line, but you get the picture. It's going to be a lot steadier than if you only own umbrellas or you only own sunscreen. So it'll be quite fluctuating. So that's the beauty of putting together complementing assets in a portfolio. You stabilize the overall impact, and it's a more systematic way of growing your capital. Now, historically, what's happened? Now, this is a really interesting slide for this presentation. What I've done here is compiled the performance of different asset classes: New Zealand shares, US shares, Australian, world shares, and I've got New Zealand property in there. And by the way, that's a residential property, New Zealand, using QE data, 6 month term deposit rates, and I've also checked in inflation. So you can see it. This whole the time period that I've captured here is about 30 years, going back to 1993, 28 years. The best performing asset class, incidentally, over this period happens to be New Zealand shares at 7.7% return per annum, closely followed by US shares and Australian shares. But here's the important bit. You can see what is happening at the end here. New Zealand shares are trending down, while US shares and Australian shares and world shares are actually pointing up. So, looking at that graph and looking at that, New Zealand shares have been the best performing asset class. You might tell me that, okay, well, chuck everything into New Zealand shares if that's the best performing asset class. Well, may not be the ideal way to go about it, because what happens if this thing keeps dropping and everything else is going up? So it's good to sort of spread yourself across. Now, the more important part that I want to come back to, when I said that 10% price appreciation for property is very unusual, is look at that. 4.9% has been the appreciation of price per annum for New Zealand residential property over the last 28 years. So 10% is nowhere a common scenario. It is a very unusual scenario. And I can tell you that 4.9% would have been lower had it not been that very unique period that we've gone through over the last 8 years. Since 2012-13 onwards till about now. And, this current spring and summer is also looking pretty positive for property prices. But this is a very, very unique period. And that has jacked up that overall return. You can see the gray line here is the property return, and it's fluctuated a little bit. So there was a flat line up until about early 2000s. It started to go up, and then again peaked at the time in 2007 when the global financial crisis happened, came down a bit, was flat until about 2013, and then it really took off. And then in 2017, there was a couple of years where it was again sort of flat to slightly moving up. And then COVID happened. And then, since COVID, it's just really taken off again. But up until from 1993 till about 2012, this other line that you see here, the slightly bluish gray line, that's the term deposits. So the return on price appreciation of residential housing and 6-month term deposits was the same from 1993 till about 2012 for the first 20 years of this period. It's only the last 8 years when property prices have really gone up. So this is a really unusual period. And, I really doubt, it's beginning to get into the commentary and the headlines as well, but it's pretty it's pretty tough for this market to keep churning out the return that it has over the last 8 years. I think we are moving into the next phase of New Zealand property from next year on. This graph expands the view, and this is showing the U.S. share market just for clarity purposes. The largest share market in the world, but the expansion of the time frame is for an entire century. Now, this goes back all the way to 1926. What I want you to focus here on is that there have been the troughs. Obviously, this was the major Great Depression, and this just continued on for a long time. There was a recovery over there, but then the World War II happened, and then there was a further one, and then since then it was followed by a pretty strong period. But this was a really unusual period. The Great Depression, there was no monetary policy. The central banks did not intervene at all in trying to support the economy. The governments just sat on their hands, didn't do anything. So a lot of businesses were allowed to fail, and it takes time for new businesses to come in and new entrepreneurs to come to the fore, set up their businesses, and start hiring people. Incomes increase, and then they start spending, and then the business cycle starts to turn. So that did not happen back then, and since then there have been further drawdowns. You can see, I can see this years. Well, this was somewhere in the 80s, I think. Can't see. Well, you have 1980, 87 was the crash. That was the 87 crash, the minus 29.6%. This was somewhere in the 60s. The oil crisis, that's what happened there. Was wondering about it. So this was the oil prices that caused a bit of a recession. The markets draw down, and then there was a strong recovery. Then the 87 crash. A lot of people, particularly the older ones, remember the 87 crash. It changed lives for a lot of people, but that is all that was. And it was followed by this recovery, the massive recovery, until the dot-com bubble burst. So that was the dot-com one, which was minus 44.7%, and it took a little while to come out of it. And then we went into the global financial crisis, which was minus 50.9%, a drop. And then it took a year and a bit to come out of that as well. So, but then there was a few years of really strong recovery, and then the COVID sell-off happened. Now, COVID sell-off was very unique because it was very short. It was minus 20%. It was more than that from peak to the bottom. But on a quarterly basis, the quarter was minus 19.6% for the US market. But that was it, and we're already past it. But this is updated until December 2020. So we recovered out of that, and we were already past it, end of last year. So what I want to highlight here is share markets have their ups and downs. They go through troughs, they have the recessions, they have the sell-offs, but they always bounce back. And the bounce back generally is always much stronger. Excuse me. So the key part is, if you are willing to hold on to the investments and you haven't invested in something that is just going to go bust, then you shouldn't really worry about the short-term volatility. It will always bounce back, and you will be able to keep moving forward. And a good financial advisor can actually help you with holding hands. So this is what the Saturn strategies have achieved over recent times. Excuse me. So you can see here we've got different strategies going from conservative all the way to very aggressive, depending on the type of risk profile that you want. The returns that you can see here, quarterly, 1 year, 3 years, and 5 years. What I want you to focus on is the longer end of things. So on the right-hand side, you've got 3 years and 5 years. That's what is more important than what's happened over the last quarter or even the last 1 year. You can see the last 5 years. The conservative one, which is the most defensive strategy that we've got, is done 4.75%, and if you were to compare that to term deposit rates over the same time, that's done 2.5%. So we are comfortably ahead of that. But for most clients, they would be falling somewhere between the conservative and the very aggressive, so the middle of the pack. So balance to balance growth. and that has done around about 10% per annum for the last 5 years. So we have achieved pretty decent returns. Depending on your risk capacity, your stage of life, and what you're trying to achieve, you would fall within one of these strategies. And again, a good financial advisor would sit with you, understand your circumstances, and understand the goals and objectives that you have, and would choose the right strategy for you. So we are pretty proud about our returns and what we've achieved. Get in touch with us. Last part, I've sort of touched upon this through the presentation. What I'll do is, how a financial advisor can help. There are various things. So I've touched upon, the financial advisor can help you start saving money by setting out, doing a budget, start accumulating by setting that amount away into an investment, and also work out a retirement plan. How much can you spend in your retirement, and how to get there by setting aside some amount. So all of those things, including KiwiSaver, developing and implementing a plan, can be done. But rather than spending too much time on that, I'd probably stop here and see if there are any questions.
Oh, great. Thank you, Shahrukh. That's quite insightful. It's always good listening to you. I think when we, what really struck me is that if we were very successful with a particular investment, it is quite common to have high conviction on that particular investment because we had such a good track record. But as people's needs change, such as going from a accumulation to decumulation stage, or as a macroeconomic environment change, it's actually quite important to stop and review. Is that still suitable? Are there better investment options out there rather than just use it as a given? Thank you. And Shahrukh has a wealth of knowledge. He is my go-to person whenever I have questions. So definitely get in touch with him.
You're just too kind, Joyce. Thanks for that.
Yep. So anyway, I want to give our audience the opportunity to ask questions. So again, just a reminder, the question functionality is at the left-hand side of your auditorium. Don't be shy. Pop your question there. If you are a slow typer as I am, it'll take a while to type it up. So I'm going to use that opportunity to squeeze in a question that I've been thinking about a lot. So Shahrukh, my question to you is that I have been reading a lot about Bitcoins lately. It come up, new ETF being launched and all that kind of jazz. So what do you think about using Bitcoins for retirement strategy?
Right. Okay. So very topical. And yes, there's a new ETF that's being launched. So there are ways of investing in Bitcoin. Now, Bitcoin is a cryptocurrency. But the name cryptocurrency doesn't really, tell you about what Bitcoin can do or can't do. It's not used as a currency, even though some might disagree with that. But you can't really use a currency which fluctuates in value by the likes of 10% or more in a day. How would you use that to pay for anything, for that matter? What is supported Bitcoin's value is its use as a speculative asset. So in my view, and that's my view again, not giving personalized advice, but just sharing my view, I feel Bitcoin's value started to go up because there was increased demand for it from investors, and then financial services operators or fund managers started to offer that to their clients just to avoid losing business, and that's created demand and started to put Bitcoin in the spotlight. But again, Bitcoin was the first mover in this space. It's not the only mover. There are heaps and heaps of cryptocurrencies that have been launched since Bitcoin was launched, and quite a few of them are also, doing rather well. But again, what happens if financial the main financial system comes up with their own cryptocurrency? So what happens if central banks come up with their own digital currencies? And I know that 70% of global central banks are already working on their digital currencies or crypto versions of their fiat currencies. Once they launch that, obviously that will be adopted by the financial system. So there is no question about blockchain as the future. But will Bitcoin be the future? Well, I'm not so sure. And I don't know. And I wouldn't want to bank my retirement on that. That's probably the most important bit I want to highlight. So while it's okay to dabble a little bit on these things, but this shouldn't be the core part of your retirement planning.
Yeah, sure. Thank you, Shahrukh. So the short answer is no, it's not the core part. Okay, so we've got a question coming from Steve. So I'm just going to read it out as it is. So at what stage in retirement do you cash in your savings to provide a return? For example, if you cash in for an annuity, would you then lose ability to have growth on your capital?
Great question. And the answer, okay, so when you say annuity generally is that you get a fixed amount paid out for forever, for the life. And it really depends on the amount that you've accumulated, the returns that potentially you're going to achieve, and the amount that you want to extract as your annuity. So again, the way a financial advisor can help you is determine or answer those questions that, okay, well, this is the amount that you should be able to extract, and the portfolio should, or the capital that you've got would still hold value by virtue of earning the return, which is essentially what is getting paid off. Whether that's the right approach is another thing, because for many clients, I ask the question that, well, what do you want to leave behind as your legacy assets? And if you own a house, well, generally, that is going to be a sizable asset that you're going to pass on to the next generation. So do you really need to leave behind financial assets as well? It's a personal choice. I'm not, again, saying what's right and wrong. You got to decide for yourself. But that is going to determine if you wanted to leave financial asset as well. Well, then that's going to diminish the amount of income that you can extract out of that capital. But if you wanted to use up that financial asset over the retirement horizon, then yep, you can extract a bit more, and financial advisor can help you determine that.
Right. Thanks, Shahrukh. We also have a question from Peter. This is in relation to commercial property. Naturally, you would expect that's a great question. So how do you view the outlook of investing into commercial property? Will there be a continuing demand for office space with the new working from home world brought on by COVID?
Fantastic. So I was one of the very initial ones to point out that there is a structural shift happening in that space, commercial property. So in my mind, I divide commercial property in three broad classes. So there is the retail part, which is the shopping malls and the shops. Then you've got office space, and then you've got the logistics or industrial side of things, which is warehouses and logistics assets. So office space. Absolutely, there's a paradigm shift here where work from home or working remotely is beginning to seem like the new normal. So while I do not foresee a future where most businesses will shut their offices for good and just move towards working remotely, there are examples of those, some very prominent names. Twitter, for example, moved their entire 5,000 strong workforce to work remotely. They do not have physical offices anymore. I think the most likely outcome going forward for office space is a hybrid approach where most businesses will have reduced office spaces because not all of their employees will be coming into work at the same time. They'll be, some of them might be working from home on a day, and the others would be in, and vice versa. So I think that means that there would be reduced demand for office space for existing office space, but there would be more demand for new office space. So the new developments that are coming online would still be in demand because they'll be offering, better facilities and better features. But that would be at the expense of existing office space because they will be losing tenants to the new office space. So there would be a bit of a trade-off, and I don't know how the old office space, I think they'll get refurbished and renovated and then probably try to match it. But overall, the demand for office space will be smaller than it was pre-COVID.
Great. We also have a question coming through on residential investment property. You mentioned earlier in your presentation there are some headwinds facing rental properties. So what is the outlook? What's actually going to happen? Is it going to crash and burn?
Oh, wow. Those are strong words, crash and burn. I wouldn't say crash and burn. Bottom line, what I expect to happen, the most likely scenario is that, this coming summer, the next 3, 4, 5 months will still be positive for property prices. But once we get into the next autumn and next winter, I think from there on, the property prices will, flatline, maybe decline a bit, but crash, well, it can happen. How? Well, just very quickly. So right now, what you've got is the new tax laws that are that have been introduced, and that means that the tax losses will be phased out. The tax deductibility, interest deductibility of against taxable income will be phased out. But that is going to start to become a reality for property investors when their accountants pick up the phone and start calling them to tell them that, oh, well, you've got a tax loss of, say, whatever dollars, and you can't claim 25% of it, you got to pay for it. But when you start to think in those terms, then suddenly you've got property investors with 10, 15, 20 properties who would want to consolidate their property portfolio to their best performing properties and away from the rest of the properties. They would be in a hurry to sell those because at the same time, most likely the mortgage rates will be going up. And now if you've got the same time borders relaxing and the first home buyers who will be the ones who will be keen to buy existing properties, remember, tax laws do not apply at this stage to new builds. So investors will be focusing on that side of the residential property market, not the existing one. So the existing properties that will be coming to the market will be purchased by owner occupiers. But owner occupiers are younger professionals who typically would be looking overseas for better paying opportunities, as has been the case over the past decades. Now, if the borders are relaxed and the bigger economies are doing better than New Zealand, which is beginning to seem like the most possible scenario, then you could have a flux of those younger professionals going out at the same time when all these properties are coming to the market and the mortgage rates are going up. With all of those combined, there could be a scenario where investors start dropping their prices to offload their loss-making properties, and that could result in property prices declining. But that's not the base case scenario. All of those things will have to align in order for that crash to happen.
Sure. So the base case scenario is flatlining. When all the conditions are primed for disaster, then that's probably.
Well, let's just put it this way: more factors are pointing towards the downside than pushing the prices up, as has been the case of the recent years. So it's not the same as it has been.
Sure. Conscious of time, I'm just going to squeeze in one last question. If your question's not answered during the webinar, we will get back to you later. So the question is, Shahrukh, you mentioned in the presentation about managed fund. Could you explain in simple terms how a managed fund can fund people's retirement? Like, how does it actually work?
So, as I said, that managed fund, you put the money into a pool. A lot of investors do, and that is managed by a managed fund, a portfolio manager, a professional. suitably qualified with a team of analysts that's looking after day in day out as to which companies should be bought into, which companies have done their bit and they should be cashed in and that money reallocated elsewhere. And that's one managed fund. What we do at Saturn is we bring together about 15, 18 managed funds from different asset classes, looking at different geographic regions or different specialties. For example, one could be looking at technology companies, primarily focused on really high growth oriented companies, and another could be focusing on healthcare, another could be looking at environmental sustainability side of things. So we try to bring in complementing fund managers together to form a portfolio which is diversified all over the world, based on fund managers that have chosen 30 to 50 companies based on their extensive research. And the overall exposure to our typical client would be about 500 to 1,000 plus companies spread across the globe, well researched. It's very robust way of developing a portfolio, and pretty unlikely that a large chunk of that portfolio will turn over and go bust. So that's how we help clients with their retirement.
Yep, fantastic. So it's getting close to 1:30, and we are respectful of people's time. So I think that brings us to the end of this webinar. Thanks to everyone who listened in. I hope you got as much out of it as I did. If you do have questions or need help with your financial planning, please do not hesitate to get in touch with Shahrukh or myself.
Before you go, so there are my details.
Yeah,
so
here's Shahrukh's detail. Take a photo of it, but we will also send the presentation along with the recording to you in the coming days. Well, hope you all have a lovely, lovely weekend.
One last bit to take away. So even if you're not ready to talk to us about investments, what you can do is go onto our website and sign up to our monthly newsletter. That's a really good way of staying in touch of what's happening in the financial markets, and I try to provide a monthly update based on my outlook. So that will give you a flavor of things, and you can then decide when to proceed or not.
Fantastic. Thanks for that, Shahrukh, and we look forward to seeing you at the next webinar. Thanks, everybody.
Take care.
Bye.